Hey there, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. Today, let's answer the question if annuities make sense if you already have a pension. Well, maybe not, but let's explore it. I have many clients who have a pension, and they have many annuities, and some have more pension income than they need, and they don't own any annuities, or they buy annuities for growth and market protection and legacy. And there are definitely reasons to own annuities, even if you have pensions. So, but it just depends on what your goals are. If your goals are just strictly income, that's all you want, you want all your money in the stock market, then no, it doesn't make any sense. But if you've got, even Social Security is a pension, okay? Social Security is a pension, so if you're retired, you have a pension that way. The Social Security is a pension; it's an annuity. But if you are lucky enough to have a pension or multiple pensions elsewhere from maybe other career paths that you've chosen in the past, and they've given you a decent pension, which I have clients who have a couple of pensions, sometimes from the government, sometimes from private companies, which are obviously it's becoming less and less common. And so they'll reach out to me and they're like, well, I have this pension, I've got this Social Security, but I also have this 401k or TSP account, or maybe you just got cash and you're thinking, I would just like to have some more income. Or if your pension is only coming in for you as a single payout, and maybe you're married, and then it reduces by 50% or completely if you pass away and your spouse doesn't have anything. It's very similar to Social Security. Social Security, of course, if you die, then the spouse gets the higher of the two payouts. So yes, it usually does make sense to still have some sort of annuity contract to supplement that income, especially if that pension money runs out later, or if you just want higher income. A lot of times it's just not enough. Okay. And so I'm going to show you my screen and show you what this can look like for you. All right. So let's pretend that you are in Illinois, you're 62, and you're going to wait to take income for 8 years. So maybe you're waiting to take Social Security at age 70 because you want to get as high as possible. And maybe you have a pension payout that's temporary. Okay, sometimes people have pension payouts that only last for a few years, and then it's gone, and they got to have something else that kicks in, like Social Security at a later date, or maybe an annuity contract. So, and maybe none of that's true. Maybe you already have pension income coming in, and you have Social Security payouts, but you still want some more income, and you happen to have some money that you want to invest into that. So with this client, they're 62, they're married, they live in Illinois, their $400,000 investment will give them income. Let's say they wait 8 years. Let's see what it is. All right, so you got Clear Springs, $54,773 a year. Nationwide is very close. Nassau and Corbridge, and lots and lots of options. So if you're just looking at the highest payout, though, that's pretty darn good. And Clear Spring's good. They used to be Guggenheim. They've been around for a while. Definitely not as big as Nationwide. So if you're looking at bigger and higher rated, then Nationwide's very close to this payout. Might make sense. So you look at this and say, okay, well, with growth, because again, they show you both. They show you, hey, here's guaranteed. If the index earns nothing, your account value doesn't last, but your income is there, and that's why you buy it. That's the contractual guaranteed income. Okay, and that's really why you get it. And so you're buying this pension. Really, what you're doing is you're buying a $1.4 million pension with $400,000. That's what you're doing. Okay, and that's if you live till 95. If you live longer, then you get paid out more, you or your spouse. This is a joint payout. If it was a single payout, the income's going to be a little bit higher because they're only on the hook for one life instead of two. So, and the fact is you let it sit here and grow for 8 years. That also gives you a higher payout. Okay, if you $400,000 in right now, you could take immediate income. It's just not going to be as high because you didn't allow it time to grow with the insurance company. So the insurance company grows your benefit base during this time period to a guaranteed amount of $799,000, and they multiply it by a 6.85 guaranteed withdrawal rate for joint. And based off of that, your income's $54,773. Now, if you change your mind, you're like, well, I might take income earlier. Let's say I wait 3 years. Okay, well, it's $34,000. Okay, if you wait 5 years, it's $41,000. If you wait 7 years and you decide, oh, I'm not going to wait 8 years, I'm just going to take it now. Well, great. It's $49,975. So you can take income at any time. That's what's so nice about these is you can set yourself up for a guaranteed pension, and you can activate that income at any time. Because a lot of times people will buy these and they're just like, I don't know when I'm going to take income. I just know I'm probably going to take it in 3 years, but I might take it earlier. And what does that look like? Okay. Or I might decide to defer it out. My job just might last a little bit longer, and I'm going to take it. I hope my job, I hope to keep my job for the next 6 or 7 years. And if that's the case, then yes, I want to defer this out that long. But if I lose my job and I can't find something that's better paying, then I want to have the choice, the ability, the flexibility to actually take this income earlier, which an income rider allows you to do that. So you can get these with SPIA and DIA contracts. You can buy pension incomes with those. Those are the classic annuities. They just don't give you the flexibility typically of changing the date or, taking it whenever you want. With an income rider, you have guaranteed growth and you can take the income. You can activate that income whenever you please. So, and I'll show you that growth, the 799,000. You're probably wondering, well, how does that happen? What they're doing is they're giving you an income-based bonus of 8%. Okay, so they're taking that 400,000, multiplying it by 8%, and then they're taking that amount and multiplying that by 8% again. Okay, at the end of the first year, you've got that compounded growth rate, putting your benefit base to 466,000. And then the next year, 466 earns 8% again. And that's why you have that compounding over time, guaranteed, and the lifetime withdrawal rate also guaranteed to go up. So if you're comparing this to just leave it in the stock market and you expect an 8% return from the stock market, then it's pretty comparable. You could leave your money in the stock market and say, all right, well, maybe at the end of 8 years, I'll activate that into lifetime income. The difference between that and this is guaranteed. You're setting yourself up for a guaranteed growth regardless. Now, the balance isn't going to grow that much. The actual cash balance you see here maybe grows to 520, maybe, if this does this, if the account delivers this, which it probably will, but there's no guarantee. And you can see the rider charges right here. They're charging you for that 8% growth rate. But the rider charges eventually go away because they're pulling from the account balance, not from your income. And once that account balance is exhausted, then there are no more fees. But the income, of course, is that's the whole reason why you got it. That is guaranteed for the rest of your life. Anyways, I hope this helps. When you're looking for purchasing a pension for yourself, usually you're looking to bridge an income gap or a need. Maybe you've got $50,000 a year coming in and you need to produce another $20,000 to $30,000 more in a year in income. It's a great way to do it. When you're looking for purchasing another pension through an annuity contract, it's a great way to fill that gap and to give yourself peace of mind and also just give yourself some extra cash. So if you want to go spend it or travel or, spend it on your grandkids, you can do that. So it's really nice. It's very flexible. You can activate it at any time you want to. And again, you notice I work with all of these companies. Okay, I work with over 70 carriers, and I work with thousands of products, and I like to show what's available. And that's why I always encourage people, go to my website, go to johnstevenson.com and check out the rates for yourself. Okay, and then when you're comfortable, if you want to use me, if you want me to help you with this annuity purchase, then please reach out. Okay, you'll see there's a book a call link on my website, and there's a book a call link right below this video. So otherwise, research and go somewhere else if you want. Okay, I'm happy to help. Would love to help you, but I hate salesy people. So, anyways, I really hope this gives you value. That's really what I'm just trying to do with this. And if you got just additional questions, send me a message or comment below. Okay, or if you like the video, make sure you click the like button, subscribe and share, and check out all my other videos. Okay, I've got a ton of videos that answer lots of different questions in different ways. So hopefully, just kind of going through that library, hopefully that'll kind of help you learn and digest and kind of decide for yourself what you want to do for your retirement. But right now, annuities are really, really popular. People love them, and they're just getting more and more popular because there's nothing like setting yourself up for guaranteed lifetime income or just market protection and growth. Like, it's nice to be able to have it. Okay, you don't have to do it with all of your money. You can do it with a portion of it and leave the rest in the stock market if you want. It's a way for you to get the best of both worlds. And that gives you a more balanced approach to your retirement, if that's what you're looking for. If you just want straight growth, and you already know, you could just keep it in the stock market. So it's totally up to you. But if you are looking for an annuity, I'd love to help. So anyways, hope that is valuable. And again, I really appreciate you for watching. Hope you enjoyed the video, and we'll see you next time.